first question, why don't you just talk to us and tell us what it's like being a regulator in crypto right now?
Sure, of course. And before I begin, I just wanted to give my standard disclaimer, which is that the views that I'm sharing today are just my own and do not reflect the views of the CFTC or of any other commissioner. I have to say, being a regulator in crypto right now is so exciting. I mean, that is the reason why I gave up my former career to, hear the call to public service, come back to the public sector and work on it, because I think right now is just such an inflection point where you have less now, but you have, $1 trillion in crypto assets that are out there. You have such widespread, investigation and adoption of this technology. And it's so important that we get the guardrails in place and that we build out the regulatory framework from the beginning. So that way, the growth that we're seeing is in compliant digital asset markets and not in something that is outside the banking system, which I've been calling, or the outside the regular financial system, which I've been calling shadow banking 3.0. So it's really an opportunity to come in to try to use my experience and my expertise, like I said, both previously when I was at the CFTC after Dodd-Frank, but then also from the private sector, to just get that balance right between innovation and between retail protections.
Is there maybe an example or two that you can share to kind of illustrate what you mean by this to my readers? With so much going on, the market cap has dropped over $2 trillion over the last 6 months or so. At the same point, investor protection is always a concern. And at the same point, the industry keeps innovating. I know, for instance, last month, you participated in a roundtable with Sam Bankman-Fried related to innovative proposal to sort of self-margin and clear derivatives. So maybe just one or two tangible examples as to kind of how you are weighing all these competing pressures.
Absolutely. So I think, first of all, one of the points that I've made recently in my public statements is that shifts in market structure is not necessarily new, either to the CFTC or to regulators generally. One of the parallels that I drew was the electronification of markets and how we are seeing that with essentially the digitalization into digital assets, where you can have assets that are essentially a tokenization of a real asset. So you just take a real asset, make a representative token, and then you put it on a blockchain. And so with these efficiencies that you can see in the technology, a lot of times you can use the existing regulatory framework. You might need to update it to look at some guidance or some interpretations where you apply it to the new technology that is truly novel. But for the most part, the CFTC's principles-based framework is technology neutral, which I do think is better. It means that the rules can be more evergreen. It means that they don't need to be updated all the time. And so that's just one example where I really see the ongoing digitalization and the growth in digital asset markets is almost very, very similar to the electronification of trading markets. So where you've had, equities to FX, to fixed income, to rates, and so on. So I think that's a really good parallel. While I can't speak specifically about any applications that are pending before the CFTC right now, I do think that it's very important to have that robust public debate and discussion. So I'm very pleased that we were able to have such a fulsome roundtable with participants from all different sectors and aspects of the markets, from your financial market infrastructures, like exchanges and clearinghouses, all the way to end users, like the farmers and ranchers that CFTC markets were originally built for.
Yeah, it's interesting. It's that roundtable is sort of must-see TV for the crypto world. It's probably the first time many people in our industry really kind of watched on the edge of their seat, almost like a sporting event. It's a similar dynamic to, I think it was a final debate or vote over the infrastructure bill last September, when there were some important tax implications, and everybody was just on hands and knees wondering if what they saw as the troublesome provision for a crypto tax was going to get included, and it was. So it's kind of interesting. Another example, aside from the digitization of markets that you've spoken to as to kind of how the CFTC approaches novel technologies and changes in market infrastructure, is swaps. I know you've spoken about it in past interviews, especially when it sort of fell under your remit during Dodd-Frank. And obviously there are certain derivative contracts in crypto that perhaps could be considered swaps, and it's just a different label that's being applied to them. So maybe you could talk a little bit about that.
Of course. So I think when you look at the different crypto assets that are out there that are used for trading purposes, of course, you have these sort of novel and digitally native crypto assets like Bitcoin. And so
Mhm.
those are digital commodities. But when you look at some of these other tokens that are out there, especially ones that aren't just, for example, a tokenized security or some other financial instrument, or sometimes you can see tokens that are out there that are essentially existing financial instruments, but they've been rebranded to be called something else. But you look at it and you're like, well,
Mhm.
economically, that looks, very similar to some kind of swap. And the definition of a swap is very broad. And so when people have been talking about the need to stand up new regulatory frameworks around this, I really appreciate from the beginning to have something that's very clear and holistic, that is a sensible and pragmatic approach to dealing with crypto asset regulation in the United States, given all the different regulators we have. But at the
Mhm.
same time, you can look at what we have that's existing. And in particular, because many of these tokens could be structured as derivatives, or they are structured as derivatives, we already have a comprehensive regulatory framework for that, that Congress put into place with the Dodd-Frank Act, where it does have the jurisdiction delineated between the CFTC and the SEC. And that's how we've brought the $700 trillion notional swaps markets under comprehensive regulation, from prudential requirements like capital and margin to business conduct requirements, risk management requirements, compliance program requirements, protections for not only market integrity, but also for users of the markets, including end users and customers.
Mhm.
So I think that's a really sensible way to look at it for, again, when you're doing that technical legal analysis over what type of financial instrument or product a particular token is. First, you identify what it is, then you know what rules go along with it.
Mhm. I believe this predated your time, I guess, this perhaps the second time around at the CFTC, but obviously you had a large settlement against Tether. I believe it was for $41 million a couple of years ago. And it was interesting to see with the it was interesting to read sort of the summary of the findings that was published, but also it was kind of interesting to me also to see that you saw Tether as falling under, and when I say you, the CFTC saw Tether as falling under its remit, because there's plenty of questions about its solvency, its legality, its constitution, but I don't think many people first saw it as a commodity. So could you maybe just speak about that briefly?
Sure, of course. So I wasn't at the CFTC at the time, so I can't speak for the commission at any rate about that. But I think what's really important about the Tether case is that it goes to show that if you are engaging in bad conduct in our markets, the
Mhm.
CFTC is going to come and prosecute you. We're going to bring an enforcement action. We're going to make sure that you're being held accountable. So I had recently outlined 10 fundamentals for responsible digital asset markets. And one of them, which is about vigorously enforcing our market conduct rules, I think is very simple. This is not anything new about what is proper when you're doing trading in markets. So for example, don't lie, don't cheat, don't steal, and be responsible. And what was really at issue in the Tether case, and is what we really wanted to focus on, is that they were misrepresenting their reserves
Mhm.
to the public. And that's something that just cannot be tolerated.
Okay. All right, that makes sense. So let's talk a little bit about regulation moving forward. I mean, there is a very big sort of question out there, and I think maybe it's just part of how the U.S. regulatory infrastructure is created, in the sense that we have sister agencies, the CFTC, the SEC, the CFPB, state regulators, et cetera. There's plenty of other countries around the world where there's just sort of one financial regulator and everything fits under it. And when I've interviewed Commissioner Peirce several times, I've interviewed Jay Clayton too. I mean, they always talk about the healthy relationship that they have with the CFTC, I guess, when it comes to crypto, but also there's been plenty of issues outside of crypto that you've had to work with them on to sort of jurisdictionally figure out a way forward, and sort of find a way to marry the whole, I guess, the competing aims of promoting innovation while protecting consumer welfare. I'd love to get your sense of sort of how that relationship works.
Of course. So this is something I think has been recognized since the very early days of when the Commodity Futures Trading Commission is in its current form. Its predecessor agencies have been around for quite some time, since the beginning of the century, but the current structure of the Commodity Futures Trading Commission was put into law by Congress in 1974, and then I believe our first chairman was sworn in 1975. So, in the early 80s, they realized that they needed to work out some of the jurisdictional lines between the SEC and the CFTC. And so you had the Shad-Johnson Accord that was put into place. That was then SEC Chairman Shad and then CFTC Chairman Philip McBride Johnson, which I actually will say was my professor in law school. So he actually taught me regulation of derivatives. That was, I think, the first attempt to really just draw a line, because they realized that the two agencies needed to work together, that we had some different financial products that had some characteristics. There's one very good example of that is security futures. And I won't bore you with all the details of how that got hashed out, but it did take quite a bit of time, and was just one example where they needed to look at the different characteristics of the products and what would be the appropriate regulatory framework around that. So I think with that,
I'm sorry, not to interrupt, but maybe not the whole history, but maybe is there one important thing learned or one key takeaway from that debate that you could share before continuing with your answer?
It's very technical, and hire good product attorneys.
Got it. Okay. All right.
It did take a long time. There was a lot of interagency working groups and a lot of a deep study by the derivatives bar and how to really draw the line there. But I think maybe a more relevant, or maybe not more relevant, but a more timely, more recent example of that would have been, over swaps versus security-based swaps. So I think, again, the Congress and of course the leaders of the SEC and the CFTC over time, having realized that it's very important for the agencies to work together. One of the first things that was required under Dodd-Frank was some joint rulemakings, in particular, a joint rulemaking between the SEC and the CFTC on the definition of a swap versus a security-based swap. And so that's something that was resolved through that joint rulemaking. And then as time has gone on over the last 12 years since Dodd-Frank was passed, there have been other areas where the SEC and the CFTC have worked together on the rules for these markets, because again, you have the same entities that are trading these products and the way that operationally it works, but you have two different regulatory rule sets. And so the CFTC, of course, under then Chairman Gensler's leadership, having implemented many of the Dodd-Frank rules within just a couple of years after Dodd-Frank was passed, and then the SEC only, I believe, last year was the first time you had security-based swap dealers being registered.
Okay. And I was going to ask you about Chair Gensler, because that is an interesting tie between the two agencies. And I think a lot of people in crypto are forgetting that he used to chair the CFTC, and I believe he was there during your first term at the agency. I'm not going to ask you about your thoughts on his performance or anything like that, because that would be inappropriate. But I think that people in this industry are still trying to understand what makes him tick, how he works, like what are some of his core North Stars, for lack of a better term. Is there anything you can share about based on your experience working with him and under him, to sort of help the industry better get a sense of what he cares about, what he's looking to accomplish?
I think Chair Gensler has spoken for himself, so that's probably, I'd better leave it at that.
Fair enough. Okay, so what are your thoughts on the Gillibrand Lummis bill?
So I think this bill is a really comprehensive attempt at laying out a really holistic regulatory framework, as I mentioned previously, over all different types of digital assets that are out there, in the United States, with U.S. firms and with U.S. Investors and consumers, and just more broadly speaking, the retail public. And so I think it touches upon a lot of different issues that people have been struggling with over the years as far as trying to get regulatory clarity. I mean, all the way from tax issues to, what do you do with a token that is an ancillary asset that is not a securities offering from the first instance, but how to provide disclosures around that to the SEC while having it be regulated by the CFTC as an ancillary asset. I think that's a really thoughtful attempt at trying to provide a runway for some of these different initiatives or projects that are getting started, at least in the early stages, when that's how they're being organized. I think, of course, then they touch upon stable coins, and there's a lot of other different aspects of the bill as well, like requiring a study for a self-regulatory organization over digital assets, having an advisory committee that's comprised of both regulators and the public. So I think these are very thoughtful, very comprehensive proposals that are in this bill. So I look forward to learning more about what the feedback is on this bill, and to see, what is the legislative process as it continues to develop and go forward.
Sure. And I think there is some hope that because it is a bipartisan bill, it has a better chance of passing than sort of the Token Taxonomy Act and some other predecessors that fell short. What is most important to you as CFTC, as a CFTC commissioner in this bill? And I would imagine that there were plenty of, obviously I know there's been plenty of discussions between your agency and in hearings and Congress. I'm sure there were plenty of informal discussions too, as the senators were trying to put together the bill. I mean, what is most important to you?
I think one of my first principles and really almost a guiding North Star for me is that when we are regulating and when people are trying to navigate regulated markets, it's so important that there are clear rules of the road. I mean, it really just stems from that. You need to know what a product is. You need to know what the rules are that apply, because if people are going to be putting in their hard capital investments, they're going to be dedicating their time and energy, really harnessing American innovation, then it's incumbent upon us as regulators to make sure that there's a clear regulatory framework with clear rules of the road so that people can have the growth in compliant digital asset markets. I mean, I really have found in all of my various discussions during my learning tours and my demos that I've had, both in the private sector and in the public sector in my current role, of some of these really innovative token projects, that people want to comply. I think that the responsible actors in the crypto asset sector want to comply, and they are just wringing their hands saying, well, but what do we do? Nobody will tell us what we do. They're spending millions of dollars on attorneys and on consultants and on lobbyists, and really trying to figure out how do they navigate this. And there really is a very serious concern that I've found about national security and about American competitiveness. And I think that's very compelling. I found it to be very sincere, and I think that's something that we can't forget either.
Actually, maybe just to quickly pick up on the national security element, because that's, I've heard like a national imperative. It's important for our own like economic standing to remain on the forefront of innovation. But how does that fit into national security for you?
I think when you look at traditional schools of thought around geopolitical power, you have, of course, military power, and you have economic power, and you have the US dollar as the world's reserve currency. So I think people are very concerned that should, because of these innovations in digital assets, in particular, if there really is a movement towards certain stable coins, for example, payment stable coins that are not, clearly they're not digital fiat, because that would be a CBDC. And they're also not tokenized commercial bank money. And so if there's ambiguity over that regulation and over what those stable coins might be, people are really worried that that's going to be a movement away from the US dollar as the world's reserve currency. And that is a national security issue for the United States, as well as a deeply monetary policy issue as well. So that's just one example. But of course, if you have other things, if you have innovation, if you have capital investment, if you have talent, all moving offshore, that's something that people see as a concern as well. And you've seen that with other sectors that have moved offshore that can put the US at a competitive disadvantage. It can be detrimental, to our standing in the world. And I think from COVID, you've seen some issues when you've had, we've got a lack of onshoring facilities. And so this is really, I think, things that people are thinking about, and it's things that people are concerned about. And I think there are also concerns about what does it mean, again, from a geopolitical perspective, if should another currency arise as the world's reserve currency, or if there's a non-state currency, so to speak, that becomes a world's reserve. That's another thing that I think people are very concerned about.
Understood. One question I've heard a few times about the bill, because I think the popular reading of it suggests that the CFTC will gain a lot more authority vis-a-vis the SEC when it comes to regulating this market, should it pass in its current form, is that the CFTC does not have the same type of manpower as the SEC to effectively monitor this marketplace. How do you respond to that?
So I think this is something interesting that people have put out there. If you look at just, budget dollars, and if you look at just headcount, the SEC has a bigger budget and the SEC has more headcount than the CFTC. But I think that also has a lot to do with the fact that the SEC regulates public capital markets and they regulate the private capital markets, and their rules are very prescriptive. Mm-hmm. And it's very important that not only is there a lot of filings and applications that have to be reviewed, but there's also many enforcement actions over prescriptive rules, which means there's more violations of those rules because they are so stringent, specific, prescriptive, really. But with the CFTC, we have a principles-based regulatory framework, and we have what our statute mandates as an effective system of self-regulation. So what we have at the CFTC is really harnessing the leverage of all of these different market participants and these market infrastructures and making sure that they are also charged with enforcing our rules. So it's not just the CFTC that needs to enforce these rules, but it's also every single registered entity that has its own rule book and has to enforce those rules as well. So I think that's a really important way that the CFTC is able to make sure that from the top all the way down, we have effective enforcement. And the CFTC has brought over 50 enforcement actions in the crypto space since about 2015, when we first came out with our action that said that Bitcoin was a commodity. And I think it's really important that people understand that the CFTC regulates not only the most complex products in the world, and that the definition of a commodity is so broad that you're talking about hard commodities like precious metals, like gold and silver, to energy products like oil, to natural gas, and then to food commodities, to lumber, to financial instruments like interest rate swaps and treasury futures, and pretty much weather derivatives as well. And there are event contracts that are under the CFTC's jurisdiction. So this is an incredibly broad swath of markets that's under CFTC jurisdiction, which have worked well for decades in our regulatory framework through incredibly volatile times of market disruption and market stresses. That's something that people don't, I think, really understand how broad the CFTC's jurisdiction is, especially because we have global jurisdiction. And I don't know any other regulator over the commodity derivatives markets with that kind of global jurisdiction. And I think as a final point, I'll note that the CFTC regulates systemically important financial market infrastructures, both US and non-US, like exchanges and clearinghouses, but also systemically important global financial institutions, banks, both US and non-US, who are directly registered with us as swap dealers. And again, that level of direct oversight over both FMIs as well as banks, US and non-US, is incredibly broad. And I think few, if any, regulator, besides I think maybe the Fed, but I would say that the CFTC actually directly regulates these FMIs to an extent that the Fed does not. Mm-hmm. So.
Yeah, and sort of, just to illustrate that for readers, like that, for instance, a regulated exchange under your jurisdiction, like the CME, can choose, it's my understanding, can choose to offer certain products, and it's sort of incumbent upon them to do the first regulatory check. The CFTC obviously can come in if it feels that it's not an appropriate project, or it's not a commodity, for instance, but it's the regulated exchanges that sort of like self-authorize certain products. That's sort of how it works?
Yeah, so we have this regime of self-certification.
That's so we certification.
Exactly. So we require that when any exchange wants to list a new contract for trading, they need to certify that it meets all of these different core principles and other specific requirements that we have, including that it's not susceptible to manipulation and other protections. Then it does go to the CFTC for review, and that's where the CFTC can step in and say that this requires further review and approval by the CFTC before it can be listed. So it is something that is been in place because of the need for new risk management products as truly users of the markets, like commercial end users or agricultural end users or corporate entities that are trying to hedge their different risks, to dealers that need to manage their risk. As these new risk management products are developed, the CFTC's statute requires that we promote responsible innovation and fair competition. And so the method of self-certification, that framework around it, really facilitates that statutory purpose and mandate.
Understood. Thanks for clearing that up. So one thing you mentioned, and I know we're starting to get a little close to time, so I'm going to try to start wrapping up soon. You look at underlying markets and their I guess, vulnerability to manipulation. Obviously, Bitcoin contracts have been offered by CME for quite some time. The SEC has so far refused to approve any sort of spot ETF, though they have approved futures-based ETFs and inverse ETFs. I'm curious, like, your thought on how the underlying spot Bitcoin market impacts the performance of futures contracts, and if I could just add a little bit more to that question too. In a more general sense, obviously, derivatives markets, the unregulated derivatives market in crypto is far bigger than the spot market and far bigger than the regulated derivatives market. So how does all that fit into your calculus?
So I think it's very important that whenever you have a type of financial product that has a reference asset, you really need to look at how that financial product is deriving its pricing, and what is the model around its pricing, and what are some of the other risk management around the development of the model and deploying that model. So I think the first thing for many of these products is, how are they structured? How are they built? What is the different ways that it deals with market risk, for example, in the specifications for that product? And so that's really where you start. But it's so important that, again, when you look at how pricing is developed, when you look at what they use as benchmarks for that reference asset, the way that those benchmarks are put together need to be free from manipulation. They need to not be readily susceptible to manipulation per our core principles. And I think looking at, for example, LIBOR and all of the work that's been done globally around strengthening benchmark reform is a really clear example of what can happen if you don't have robust methods around developing benchmarks, that you then have products that use those reference assets for pricing purposes. So it's really something that's a much, I think, bigger issue that needs to be viewed in context and holistically. So that's another reason why it's so important that we put regulation around the spot crypto markets, because of the fact that you do have other financial products that are keyed off the prices that are and the benchmarks that are being developed around spot crypto products. And we need to make sure that those are robust. And, that has been a concern that the SEC has pointed to as for why it's not yet approved a spot Bitcoin ETF. And so I think that we've seen that with our listed Bitcoin futures markets that they have performed well, and especially because of the way that they are put together, that we feel comfortable with those products. But it's always something where the deeper and more liquid the asset class, then I think you're going to find more reliability as well, better price discovery.
Okay. Last couple. I'm curious. One of the big, I think, trends, especially in one of the big recent investing trends, is retail participation in derivatives markets, options in particular, both in crypto and honestly in traditional equities. I'm curious your thoughts on when you think it might be appropriate, or what is an appropriate level of involvement for retail traders to get involved in derivatives, and in particular, margin is something, borrowing funds to invest can become particularly troublesome, especially for novice investors that don't quite understand what they're doing. So I guess, like, what are your thoughts on, maybe you can answer this, but your thoughts on when it's appropriate to get involved, or how the CFTC works to make sure that retail investors, to the extent they are able to participate in these markets, do so as responsibly as possible?
This is such an important question. I'm so glad that you're asking it. So first of all, one of the things that I've been saying when we've tried to come up with a pragmatic approach to regulation of digital assets is that as we are looking forward, we have to also not forget to look back. So these are issues that have been dealt with before, and where there are lessons learned that we can take to heart and see, what worked in the past and how have things worked since then, and how will that apply perhaps to this product and this asset class, and what really should we be taking forward from that. So for example, with retail foreign exchange products, retail Forex or retail FX, that's an area where there was a lot of not only interest from retail participants, but then there were also a lot of scams and fraud that were in place. And it was really just awful how you always have, it seems, the scammers and the fraudsters moving in first into new and innovative areas, particularly ones that have a lot of press coverage and a lot of hype, or what you want to call it. So when you had that happening with the retail Forex markets, that's where Congress stepped in and said, you know what, we should have the CFTC, who is experienced in this asset class, who is experienced with dealing with these products and with the different types of derivatives on FX, should have a comprehensive framework around it. So there's a registration framework, there are financial resource requirements, there are market conduct requirements, market integrity requirements, there's reporting to regulator requirements, compliance requirements, risk management requirements, the whole 9 yards, really. And so I think looking to the retail Forex example of how that regulatory framework was built around that space and whether it worked or didn't work, or how it could be improved. I mean, it does work, so it is working, but if there's anything that could be improved or something to make it maybe more fit for purpose for crypto assets. So I think that's one. But then there's another one. I mean, we have, again, a whole regulatory framework around spot retail leveraged commodity transactions. So where people are trading on margin, or where there is financing. And again, that's another place where the Congress has given the CFTC that authority in our statute, and we've built up a whole regulatory framework around it. And these have been around for a couple decades. So again, this is a really important place that, as we are seeing the what's happening right now, that we have to not forget to look at the lessons learned that we have from the past and see what works, and if it works here too.
Great. And just to wrap up, because I know we're just about at time, is there anything that I did not ask that you'd like to share or mention?
Thank you. Yes, one of the things that I keep saying that's so important is that we are really, that regulators and the public sector really need to engage with the private sector. They need to engage with people who are running the businesses, who are putting their money where their mouth is, who are investing in these areas and building up firms and creating that innovation that is so characteristic of America and Americans and American markets. And so through my Global Markets Advisory Committee, which are these federal advisory committees that different federal agencies can utilize to have a structured and formal way through which to engage with the public and to get public input into policymaking issues of great import to the United States. So through that, I want to make sure that we are really looking at ensuring that there's a level playing field for global businesses and global markets around the world, and in making sure that as we are building out responsible regulatory frameworks, that we are promoting international engagement and global cooperation and coordination, because these are global markets. And because it's so important that, again, you have not this instance where there's a race to the bottom, for example, or there's regulatory gaps between jurisdictions, or we have unintended consequences like market fragmentation or regulatory arbitrage. So I'm really looking forward to using my Global Markets Advisory Committee to further explore these issues with the experts from the industry who are doing this every single day. And some of the different areas that we could look at, for example, are global market structure, or also digital asset markets.
Mm-hmm. Okay, great. Well, that's all the time we have. Commissioner Pham, thank you very much for speaking with us. Look forward to talking again soon.
Thank you so much for having me.